Building wealth that transcends the fluctuations of time and the weaknesses of human nature depends not on secret mathematical formulas or the ability to predict the future, but on the architecture of a profoundly rational and anti-fragile system of thought. Inspired by the centuries-old wisdom of Charlie Munger and the principles of systemic robustness, this treatise explores the convergence of asset management and cognitive psychology. In the following pages, the biological biases that act as erosive forces on wealth are dissected, while mental models designed to enable investors not only to withstand volatility, but to profit from it, are proposed. Understanding that the market is a reflection of our own psychological flaws is the first step in safeguarding our capital. Here begins a journey toward intellectual sovereignty, and where discipline, patience, and the elimination of error become the ultimate compass for lasting financial freedom. To understand the true nature of wealth, we must first strip the mind of its most primitive illusions and accept that we are, by evolutionary design, biological machines programmed to survive on the savannah, not to thrive in a complex global stock market. Charlie Munger always insisted that financial success is not a matter of greater technical intelligence, but rather a lower propensity for systematic stupidity. Most investors fail not because they don't know what to buy, but because they cannot control their own biological impulses when the environment becomes hostile or euphoric. Understanding the psychology of human judgment is, therefore, the most important defensive moat any individual can build. If you cannot see the cracks in your own thought process, no amount of capital will save you from the consequences of your internal biases in times of greatest pressure. The first major obstacle on the path to rationality is incentive bias, a force so powerful it can lead even the most honest and brilliant people to completely erroneous conclusions if their livelihood depends on it. Munger used to say, "Never ask a barber if you need a haircut," and this maxim applies to every corner of the financial world. From Wall Street analysts to real estate agents, nearly everyone who offers you advice has an incentive structure that isn't necessarily aligned with your long-term survival. Mental anti-fragility begins with recognizing that most of the arguments we hear are post hoc rationalizations designed to benefit the speaker's bottom line. Learning to automatically discount any opinion coming from someone with a conflict of interest is a basic but crucial safety measure. The tendency toward reciprocity is another psychological driver that marketing and finance professionals exploit to weaken your defenses and force you into suboptimal decisions. We are programmed to return favors, however small, and this social pressure can lead us to hire expensive services or make dubious investments simply because someone treated us with calculated kindness or offered us an initial gift. In the context of investing, this vulnerability makes us susceptible to manipulators who use politeness as a Trojan horse to access our capital. A rational thought system must include a conscious firewall against these social pressures. You must learn to separate personal interactions from business logic. Being able to say no to a bad offer, even if the person presenting it is charming or has done you a favor, is a prerequisite for financial sovereignty. The consistency and commitment bias is the trap that compels us to continue investing in a mistake simply because we have already publicly declared our position or dedicated previous resources to it. The human mind is terrified of cognitive dissonance and prefers to go down with the ship rather than admit that the initial thesis was incorrect. This behavior is at the heart of fragility, the inability to change one's mind in the face of new evidence. Munger practiced the habit of destroying his most cherished ideas every year, a form of mental hygiene that allows the system to adapt and survive. If you find yourself defending an investment simply because you don't want to look foolish in front of your friends or associates, you have already lost the battle for rationality. The market has no memory of your past commitments, and neither should you if you want to protect your future. The tendency toward envy and jealousy is perhaps the most foolish source of suffering and poor financial decisions, as it pushes individuals to take excessive risks simply to match the apparent success of others. In Munger's psychology, envy is a cardinal sin that offers no reward, unlike other vices that at least provide momentary pleasure. Seeing someone less talented than you earn money faster is a true test of your emotional resilience. If you allow the success of others to dictate your risk tolerance, you are handing over the keys to your wealth, to luck, and the whims of the market. True financial independence includes the stoic ability to observe other people's bubbles and euphoria without feeling the need to participate in them. Your only competition is your own ability to follow a logical and disciplined process over time. Availability bias leads us to give disproportionate importance to information that is readily available or that we have heard most recently, ignoring historical data and long-term statistics. This cognitive limitation causes us to overreact to the day's news, whether it's a burst of optimism about a new technology or a sudden panic over a geopolitical event. The anti-fragile investor combats this tendency by using checklists and studying economic history in depth, which gives them a perspective that most people lack. By understanding that extreme events are rare but inevitable, and that today's news will be irrelevant in 5 years, you can avoid impulsive decisions that destroy compound interest. Wisdom lies in focusing on what is important and permanent rather than what is merely noisy and recent. The contrast bias is what makes us perceive a bad investment as good simply because it's slightly better than a disastrous option we just evaluated. Scammers and low-level salespeople use this technique to manipulate our perceptions, first presenting us with an absurdly expensive offer so that the second one seems like a bargain, even though it's still overvalued. In portfolio design, this bias makes us vulnerable to buying mediocre assets during a market downturn simply because they're cheaper than a month ago without considering their true intrinsic value. A rational thinker evaluates each opportunity in absolute terms and relative to their circle of competence, not against past prices or arbitrary anchors. Anti-fragility requires that your value system be internal and robust, not dependent on the contrast tricks the market throws at us daily. The authority effect leads us to blindly follow experts or renowned figures, delegating our responsibility for critical thinking to someone who wears an expensive suit or holds a prestigious degree. Munger was always highly critical of academia and financial gurus, pointing out that many of their theories are elegant but useless in practice. Extreme fragility arises when you entrust your wealth to a system you don't understand simply because an authority assures you it's safe. To be anti-fragile, you must develop your own mental model lattice that allows you to audit others' claims against the first principles of logic and reality. Don't accept any investment thesis that you couldn't explain to a 10-year-old. True authority comes from evidence and results, not social status or academic credentials. The tendency toward over-optimism and the illusion of control leads us to believe we are better drivers, better investors, and luckier than average, causing us to ignore necessary safety margins. This biological arrogance is what allows financial bubbles to grow to absurd levels before bursting with devastating force. Psychological anti-fragility requires a healthy dose of stark realism. You must plan for the worst-case scenario while hoping for the best. Recognizing that luck plays a role in success and that the future is inherently unpredictable forces you to build defenses that others, in their euphoria, deem unnecessary. Overconfidence is the precursor to ruin. Intellectual humility is the foundation of survival. Never assume you have complete control over a system as complex and volatile as the global economy. The Lollapalooza effect is the term coined by Munger to describe what happens when several of these psychological biases act in the same direction simultaneously, creating a force of collective irrationality that is almost impossible to resist. It's what we see in cults, bank runs, and stock market manias, where social pressure, economic incentive, and fear of loss combine to override human judgment. Understanding this phenomenon is the ultimate defense. If you can identify when a Lollapalooza effect is forming, you can steer clear of the danger before the crowd plunges over the precipice. Anti-fragility isn't just about avoiding individual errors, but about recognizing systemic storms of human stupidity and positioning yourself well out of their path. Rationality is your anchor in a sea of collective madness that repeats itself, in different guises, in every generation. The tendency toward curiosity is, paradoxically, one of the most powerful anti-fragility tools humans possess, provided it is directed toward understanding the fundamental laws of reality and not the ephemeral noise of the market. Munger emphasized that a curious person who constantly seeks to understand the why of things develops a mental structure capable of detecting anomalies and opportunities long before the masses. Intellectual fragility arises when we stop asking uncomfortable questions and accept the prevailing consensus as absolute truth. By cultivating a multidisciplinary curiosity, integrating knowledge from psychology, engineering, and history, you create a cognitive safety net that allows you to navigate crises that paralyze narrow-minded specialists. The curious mind never stops learning, and in the compound interest of knowledge, that accumulated learning becomes the most valuable and inflation-resistant asset. The loss aversion bias is an evolutionary drive that makes us feel the pain of a financial loss twice as intensely as the pleasure of an equivalent gain, often paralyzing us at critical moments. This bias is a source of extreme fragility because it pushes us to cling to plummeting assets, hoping for a rebound that never comes, just to avoid the emotional pain of realizing the loss. The anti-fragile investor trains their mind to see losses as data, not personal wounds, and understands that capital is simply a tool for resource allocation. If the investment thesis is dead, the opportunity cost of holding on to that money is far greater than the pain of admitting a mistake. Overcoming this biological barrier requires almost mechanical discipline where decisions are made based on expected future value, not past purchase price. The tendency to overreact to the socially prominent explains why financial fads and trendy cryptocurrencies manage to capture the attention and capital of millions with so little real substance. We are hardwired to pay attention to what everyone else is discussing, an instinct that was useful for detecting dangers within the tribe, but is disastrous for asset management. Psychological anti-fragility involves developing selective blindness to what is popular and an obsessive focus on what is valuable. Munger always admired the ability to ignore the noise and focus on financial statements and the quality of the economic moat. If an investment requires the majority of people to agree in order to work, it is inherently fragile. True wealth is often built quietly, away from the glare of social prominence and sensationalist headlines. Hindsight bias is what makes us believe, once an event has occurred, that it was entirely predictable from the start, fostering a false sense of security about our ability to foresee the future. This bias is dangerous because it makes us underestimate the role of chance and uncertainty in the markets, leading us to take excessive risks the next time under the illusion that we saw it coming this time too. An anti-fragile thinker recognizes that the world is a succession of random events and that their past success may have been due to luck as much as skill. Therefore, they never abandon their safety protocols even after a prolonged winning streak. Maintaining the humility that we don't know what will happen tomorrow, despite how easy it seems to explain what happened yesterday, is the foundation of an investment system that survives cycles. The response tendency to alcohol and drug misuse is a point Munger addressed with brutal seriousness, not out of moralism, but out of sheer logic for financial and mental survival. Rational judgment is a delicate balance that can be permanently destroyed by chemical dependency, wiping out decades of wealth building in a single period of impaired judgment. The biological fragility introduced by addictions is the fastest path to the risk of ruin we must so desperately avoid. An anti-fragile system requires that the primary operator, your brain, be in optimal working condition at all times. In a world filled with distractions and easy escapes, maintaining sobriety and mental clarity is a massive competitive advantage. Discipline in your personal life translates directly into discipline in your portfolio. A lack of control in one area will inevitably bleed into the other, weakening your entire strength. Representativeness bias leads us to judge the likelihood of an event based on how similar it is to other past events, ignoring the fundamental laws of probability and statistics. For example, if a company has grown rapidly over the past 3 years, we tend to assume that this is its representative nature, forgetting that mean reversion is one of the most powerful forces in the financial universe. Anti-fragility requires us to look beyond superficial appearances and analyze the hard data and underlying incentive structures. Don't assume the future will be a mirror of the recent past. Assume that change is the only constant. By distrusting linear trends and looking for breaking points, you position yourself to protect yourself when the representative narrative collapses and reality rears its head with full corrective force. The stress-influence tendency is crucial to understanding why even the best-laid plans fail when the pressure mounts, as chronic stress triggers the release of adrenaline and cortisol, clouding the prefrontal cortex and activating instinctive fight-or-flight responses. A fragile investor operates under constant stress due to leverage or a lack of liquidity, guaranteeing they will make the worst possible decision when the market crashes. To be anti-fragile, you must design your life to minimize unnecessary stress, maintaining margins of safety so wide that price fluctuations don't affect your pulse or your sleep. The ability to think calmly when the world is burning is what allows great capitalists to buy when there's blood in the streets. If your investment system causes you constant anxiety, the problem isn't the market, but the fragility of your emotional and financial structure. The authority bias is exacerbated by the superstitious tendency where people seek magical patterns or gurus with secret formulas to avoid the hard work of rational thought and financial statement analysis. We look for profits on Wall Street because the future terrifies us, and we prefer false certainty to honest uncertainty. Anti-fragility arises from the total rejection of superstition and the cult of personality. It is based on empirical verification and ironclad logic. Munger urged us to be our own analysts, to distrust macroeconomic predictions, and to focus on what is knowable, the value of a business and the quality of its management. By eliminating the need to believe in something external, you become invulnerable to the deceptions and manipulations suffered by those who seek a magic compass in a purely probabilistic world. The deprivation error tendency is what happens when someone loses something they already had or almost had and overreacts to recover it, often taking on far greater risks than initially anticipated. It's the syndrome of the gambler trying to recover their loss on the last bet of the night, or the investor averaging down on a failing stock simply out of a desire to break even. This is a source of lethal fragility. Anti-fragility requires the stoic acceptance of loss and the ability to walk away when the odds have shifted. Your capital is a tool, not a trophy. If part of it is lost, the only thing that matters is protecting the remainder and seeking the best new opportunity available. The desire for revenge against the market is an emotion that only leads to faster and more painful ruin. Finally, the sensory association tendency leads us to link past success to irrelevant factors, such as a luxurious office or an extravagant lifestyle, believing these to be the causes of wealth rather than its byproducts. Fragility arises when we try to mimic the appearance of wealth before building its solid, anti-fragile foundation. Munger and Buffett have lived in the same modest homes for decades because they understand that luxury is often a distraction that consumes capital and clouds judgment. True wealth is invisible. It's money not spent, choices not exercised, and the freedom of not having to impress anyone. By breaking the association between spending and success, you free yourself from social pressure and can focus all your resources on the only goal that matters: the uninterrupted growth of your wealth, under a logic of eternal survival. The hostile reciprocity bias is the destructive counterpart to gratitude. It's the biological tendency to respond to aggression with aggression of equal or greater magnitude, which in the business world often leads to costly litigation and price wars that destroy value for everyone involved. Munger warned that allowing anger or a desire for revenge to dictate a financial decision is a form of extreme fragility, as it clouds cost-benefit analysis. An anti-fragile investor practices strategic indifference. If a partner betrays them or a competitor acts unfairly, they assess the situation objectively and choose the path that minimizes the loss of capital and time, rather than seeking expensive emotional gratification. Peace of mind is not just a spiritual state. It's an economic asset that allows you to keep your resources focused on capitalization while your competitors waste their energy on conflicts that don't generate value. The curiosity tendency for novelty makes us vulnerable to the New Age fallacy, where we believe that traditional economic rules no longer apply due to disruptive technological change. This misdirected curiosity pushes us to abandon tried and tested economic moats to chase loss-making startups under the promise of infinite growth. Anti-fragility, however, is based on the principle that the fundamentals of human nature and accounting are immutable. Munger always urged us to look for what won't change in the next 20 years rather than trying to guess what will be the next big thing. By anchoring your wealth in basic human needs and enduring competitive advantages, you protect yourself against obsolescence. True intelligence lies not in discovering the new, but in recognizing the persistence of the old and valuable in a world obsessed with superficial novelty. The simple association effect is a psychological error where our mind links a past success or failure to an irrelevant circumstance, creating a financial superstition that distorts future judgment. For example, if you made money on a stock recommended by a friend at a golf course, your brain might mistakenly associate golf or that friend with financial success. This bias makes you vulnerable because it disconnects you from real causal analysis. You start making decisions based on non-existent patterns rather than sound business logic. To combat this, the rational investor must practice rigorous attribution, dissecting each success to separate luck from skill. If you cannot identify the exact economic mechanism that generated the profit, You must assume it was chance and not allow that event to influence your confidence or future decisions. The social comparison tendency not only breeds envy, but also produces conformity bias, where individuals feel safe simply because they are doing the same thing as the rest of the group. In finance, this translates into herd behavior that inflates bubbles and exacerbates panics. The fragility here is systemic. If your security depends on consensus, you will fall when the consensus is wrong. Munger emphasized that to be a successful investor, you must be willing to look like a fool or a hermit for extended periods. Anti-fragility requires internal validation of your mental models. If your analysis of a business is sound and the financial statements support it, the fact that the market disagrees with you is not a threat, but a potential opportunity. True financial freedom begins the day you stop seeking crowd approval for your investment decisions. The reckless optimism bias is the tendency to ignore baseline failure rates in favor of a heroic personal narrative, leading to a lack of diversification and the dangerous use of leverage. Many entrepreneurs and investors believe they are the exception to the rule, ignoring the fact that 90% of new businesses fail within the first decade. An anti-fragile system, on the other hand, uses operational pessimism. It assumes that things will go wrong, that revenues will fall short of projections, and that costs will exceed expectations. By designing your financial life under these conservative assumptions, you create a safety net that absorbs reality. You don't need to be a genius if you are simply able to survive the mistakes that destroy unprepared optimists. Survival is the ultimate victory in an environment where most people self-exclude through overconfidence and a lack of realism. The pain and deprivation response tendency can lead to what Munger called stress saturation, a state where the mind gives up and accepts any quick fix, however destructive, to stop immediate suffering. In a liquidity crisis, this bias causes people to sell their best assets for a fraction of their value to cover smaller debts, or to accept usurious terms that guarantee their long-term ruin. Anti-fragility is built before the crisis, eliminating the possibility of falling into this state of extreme vulnerability. By being debt-free and having surplus reserves, you maintain control over your mental faculties when others are operating in biological survival mode. The ability to not be forced to act by financial pain is the ultimate luxury and the greatest defense against predators who seek to capitalize on the desperation of others. The narrative bias compels us to create coherent, linear stories to explain a world that is, to a large extent, chaotic and random. We prefer a well-structured lie about why the stock market went up today to the honest truth that no one knows for sure. This need for stories makes us fragile to charlatans who sell visions of the future wrapped in persuasive rhetoric. An anti-fragile investor must be a story skeptic, always looking for the raw data and underlying incentives that the narrative tries to hide. Munger taught us to be wary of shiny PowerPoints and to focus on the reality of the cash register. If an investment thesis hinges on a complex story about the future, it's probably fantasy. If it hinges on real profits and a dominant market position today, then you have something solid to build on. The mistaken authority influence trend manifests itself today in the following of financial influencers who possess charisma but lack a track record or a solid mental framework. In the age of rapid information, the appearance of success is mistaken for genuine competence, creating a new layer of fragility for young investors who emulate lavish lifestyles financed by debt or temporary luck. To be anti-fragile, you must apply the longevity filter. Don't listen to anyone who hasn't survived at least 2 complete market cycles with their capital intact. True authority lies not in the number of followers, but in the ability to have maintained rationality and solvency for decades. Learning to distinguish between the noise of popularity and the signal of accumulated wisdom is one of the most difficult and necessary skills to cultivate today. The false consensus bias causes us to overestimate how much others agree with our own beliefs, leading us to ignore tail risks and fail to prepare for abrupt shifts in public opinion or government regulation. We believe our worldview is the norm, and we are surprised when political or economic reality takes an unexpected turn. Mental anti-fragility requires us to actively seek out intelligent people who disagree with us and listen to their arguments with an open mind. Munger used to say that he didn't feel entitled to an opinion on something until he could argue against it better than his opponents. This practice of constant self-challenge is what prevents your system from becoming rigid and vulnerable to surprises. True security doesn't come from being right, but from deeply understanding all the ways you could be wrong. Finally, the using what we don't use trend describes the atrophy of our mental faculties when we stop practicing critical thinking and rigorous analysis, delegating our decisions to algorithms or advisors. If you don't exercise your ability to read balance sheets and understand business models, you become vulnerable to deception and obsolescence. Financial anti-fragility is an active discipline that requires a lifelong commitment to self-education. Munger, even at 99, continued reading and analyzing new businesses, not out of financial necessity, but to keep his mental machinery well-oiled. The day you stop challenging your brain with complex problems is the day you begin to become vulnerable. Lasting wealth is the byproduct of a mind that never allows itself the laziness of ceasing to think for itself, protecting its intellectual sovereignty against the entropy of time. The action bias is a psychological compulsion that drives us to intervene and make constant changes to our investment portfolio simply to feel in control, especially during periods of high volatility. Munger observed that most investors cannot tolerate inactivity, leading them to sell quality assets at the first sign of panic or buy dubious new products just to avoid being left out. This hyperactivity is a massive source of fragility, as it increases transaction costs, errors in judgment, and unnecessary tax liabilities. Anti-fragility, on the other hand, often manifests as the ability to do nothing. If you have selected businesses with deep economic moats and ethical managers, time is your greatest ally. Learning to master the impulse to do something and allowing capitalization to work quietly is the hallmark of true financial mastery. The incentive over-responsiveness tendency is so powerful that it can corrupt even the best designed systems if not monitored with fierce skepticism. Nearly every corporate and financial disaster in history can be traced back to an incentive structure that rewarded sales volume or short-term profits over the long-term survival of capital. An anti-fragile investor must be a forensic analyst of incentives. How is the CEO paid? What are the financial advisor's bonuses? What motivates the analyst who issues the report? If the incentives are designed to encourage excessive risk-taking, the structure is inherently fragile and will collapse sooner or later. You must look for situations where there is total alignment, where decision-makers have their own wealth significantly at stake. Only when there is real skin in the game can you trust that prudence will guide business execution. The anchoring effect makes us overly reliant on the first piece of information we receive, such as the price at which we bought a stock or its all-time high, distorting our ability to assess its current intrinsic value. If a stock falls from $100 to $50, the fragile investor feels anchored at the 100 price and perceives 50 as a bargain, without investigating whether the company's fundamentals have suffered permanent damage. This mental rigidity is what prevents many from cutting their losses in time or recognizing when an opportunity has turned toxic. To be anti-fragile, and you must periodically practice mental tabula rasa. Ask yourself if, with the information you have today, you would buy that asset again at the current price. If the answer is no, the position should be liquidated regardless of the original entry price. Your loyalty should be to present reality, not to your past mistakes. The association by similarity tendency leads us to believe that because two situations share superficial characteristics, they will have the same economic outcome, ignoring critical second and third-order variables. This psychological error is what causes investors to look for the next Google or the next Amazon in companies that lack the same competitive advantages or the same market context. This fragility stems from intellectual laziness, which substitutes simplistic analogies for in-depth analysis. Munger taught us that each business must be evaluated based on its own fundamental principles, its cost structure, its pricing power, and its reinvestment capacity. Don't be seduced by the easy comparisons of stock market promoters. Look for the subtle differences that separate a champion from an imitator. Wealth is built by understanding the uniqueness of exceptional assets, not by following superficial patterns that chance usually disproves quickly. The false certainty bias is the refuge of those who cannot tolerate the ambiguity of the real world and seek solace in complex mathematical models or expert predictions promising guaranteed results. The financial industry exploits this vulnerability by selling products with protected capital or trading algorithms that appear to eliminate risk, when in reality they only conceal it or transform it into systemic fragility. An anti-fragile investor accepts that risk is an inherent part of life and investing. They don't try to eliminate it, but rather manage it and position themselves to make it an ally. By acknowledging uncertainty, you force yourself to maintain wider safety margins and diversify your income streams in a real, not cosmetic way. True security doesn't come from eliminating volatility, but from the robustness of your structure to withstand it and capitalize on it when those seeking certainty panic. The acute stress influence tendency explains why people make disastrous financial decisions in the opening minutes of a crashing market or after receiving unexpected bad news. At such times, the brain enters a state of amygdala hijack that overrides any logical reasoning accumulated over years. Emotional fragility is the greatest enemy of capital. To combat this, you must establish calm protocols, pre-written rules that prohibit you from trading under stress and require you to wait at least 24 hours before making any significant moves with your portfolio. Munger always traded with deliberate restraint, knowing that haste makes waste. By slowing down your decision-making process, you allow your rational system to regain control, protecting your wealth from the emotional spasms that define the crowd and that often mark the worst times to act. Confirmation bias is perhaps the most insidious of all, as it leads us to actively seek out information that supports our current beliefs and to ignore or discredit any evidence that contradicts them. If you're convinced an investment is brilliant, your mind will filter out only the positive news, creating an echo chamber that blinds you to growing risks. This is the perfect recipe for extreme fragility, an investor walking blindly toward the abyss. Anti-fragility requires you to be your own fiercest critic. You must actively seek out the most intelligent people who hold opposing views and try to understand their logic with complete honesty. If you can't convincingly refute their arguments, your position is fragile, and you should reduce your exposure. Truth doesn't fear questioning, but your wealth should fear intellectual complacency. The availability contrast error. Tendency occurs when we compare a current opportunity to a recent one that was exceptionally good or bad, losing sight of historical averages and base rates of return. If you've just experienced a 50% annual gain streak, a solid 10% return will seem unacceptable, pushing you to take unnecessary risks to recapture that feeling of easy success. Conversely, after a crisis, any risk will seem excessive, causing you to miss out on generational opportunities because of the fresh memory of the pain. An anti-fragile system uses long-term historical data as an anchor, recognizing that euphoria and depression are temporary deviations from the mean. By decoupling your expectations from the immediate past and anchoring them in decades of statistical reality, you avoid the emotional swings that destroy the consistency necessary for compound interest to flourish and be sustained over time. The sunk cost fallacy keeps us tied to bad business relationships, dead-end jobs, or failed investments simply because of the time and effort we've already invested. The human mind feels a sharp pain when abandoning a project halfway through, perceiving the change as a personal failure rather than a necessary correction. However, financial anti-fragility demands a pragmatic view of the future. What's already been spent is gone forever. All that matters is making the best use of your next minute and your next dollar. Munger urged his followers to be learning machines, unafraid to discard old ideas or losing positions. By freeing yourself from the burden of the past, you become agile and able to redirect your resources to where they will truly generate value. The ability to surrender in the wrong battle to win the economic war is one of the greatest displays of wisdom. We conclude this treatise with the tendency toward senescence and the atrophy of judgment, a reminder that mental anti-fragility is not a state achieved and maintained effortlessly, but a discipline that must be practiced until one's last breath. Accumulated success can breed a dangerous complacency that makes us forget the basic rules of survival that brought us to the top. Munger, well into his hundreds, maintained an ironclad intellectual discipline, reading, debating, and challenging his own mental models every day. True wealth is that which is protected by constant rational vigilance against one's own stupidity and biological biases. If you can integrate these lessons and build a system that not only withstands chaos but is strengthened by it through learning and prudence, you will have achieved true independence. You will not only be wealthy, but you will be free from the chains of your own mind, ensuring a legacy of wisdom and stability forever.